Welcome to Know What You Are Investing podcast. We decode the world's top companies, on what they do, how they grow, why it matters. Today, we're diving into Cloudflare, the company working on building a better internet with security, performance, reliability services.
Exactly. And we've got the goods, their Q1 2025 earnings call transcript, and the 10Q filing.
Right. So our mission today is to really pull out what matters from all that data.
We'll hit the key areas. Revenue growth, how they're landing those big customers, network efficiency, think bandwidth, cash flow, and of course, the risks.
Basically giving you the core insights into Cloudflare's health right now and maybe a glimpse into their future.
That's the plan. A clear, concise rundown.
Okay, let's jump into growth then. Q1 2025. The headline number looks solid, $479.1 million in revenue. That's, what, 27% up year over year?
Yeah, 27%. Strong top-line growth. But what's really telling, I think, is who is driving that growth? The large customer segment.
The ones spending over $100,000 a year.
Precisely. They're now at 3,527 of those customers. That's a 23% jump from last year.
Okay, so they're definitely making inroads into bigger enterprises.
Absolutely. It shows the strategy is working. It's not just about quantity, it's about the quality, the size of the customer relationship.
And these bigger fish, they're making up a larger chunk of the total revenue now, right?
They are. Revenue from those large customers. It grew 32% year over year, and now it's 69% of total revenue.
69%. Wow, that was 67% last year.
That's right, up from 67%. So you see that concentration increasing, which can actually mean more predictable revenue streams down the line.
And they highlighted record numbers for even bigger spenders, too, like over $1 million and $5 million annually.
Yeah, really impressive figures there. The number of customers spending over $1 million annually jumped 48%, and the over $5 million club grew by 54%. That really signaled traction with, the very top tier.
Okay, this is where it gets really interesting for me, those specific contract wins. The biggest one ever, over $100 million, driven by their Workers platform.
That's a huge signal.
What's that tell you? I mean, Workers is their developer platform, right?
Exactly. It suggests Cloudflare is becoming more than just infrastructure security in the traditional sense. They're becoming a platform where developers build. That expands their market significantly, makes them stickier.
Right. And they also mentioned their longest ever contract for Zero Trust. So confidence in their security suite seems high too.
Definitely. Enterprises are making long-term bets on their Zero Trust architecture.
Then there was that Asia-Pacific government deal, $4.8 million over 3 years. They mentioned cloud-first security and network visibility. Why is that visibility piece so key?
Well, seeing traffic at that fundamental network layer gives you much deeper insight into threats. It's foundational for security, especially against complex DDoS attacks. For a government agency to choose them highlights that capability for, sensitive environments.
Got it. And the other one, the $9.3 million expansion with a Fortune 500 tech company. They apparently moved away from a hyperscaler.
Yeah, that was interesting, citing better security and automation from Cloudflare.
So does that mean Cloudflare's specialized focus is giving them an edge even against the giants?
It certainly suggests that for specific needs like advanced security and performance, their focused approach might be more compelling than the broader offerings of the hyperscalers. And the fact that they're already talking about more business with that client.
Yeah, that speaks volumes about satisfaction. Okay, let's round out the growth picture. Dollar-based net retention, DBNR, was 111% in Q1, steady from the previous quarter. What's the significance there?
So 111% means, on average, their existing customers from a year ago are spending 11% more today, even after you account for churn. Holding steady sequentially is good news.
Especially with some headwinds they mentioned around certain contract types affecting revenue recognition.
Exactly. It suggests stabilization and continued ability to upsell and expand within their base, which is healthy.
All right, shifting gears to the network. The pipes, the infrastructure, they talked about investing ahead of demand, diverse supply chains, positioning it as an advantage over on-prem hardware.
Right. The idea is resilience and cost control. By not being tied to one vendor, having multiple sources, including their own white boxes, they can manage costs and avoid disruptions, like, say, from tariffs or trade issues.
And they mentioned their infrastructure team became world-class during COVID in terms of getting gear where it needs to be.
Yeah, managing that global logistics challenge seems to have really sharpened their operational efficiency. That flexibility, using big vendors and their own stuff, gives them agility.
And architecturally, for DDoS attacks, this every server does everything model. How different is that, really?
It's fundamentally different from competitors who might have separate, specialized scrubbing centers. Cloudflare's approach means their entire global network capacity can absorb an attack automatically. There isn't a bottleneck.
So as attacks get bigger, their architecture just scales better.
That's the core advantage. Their distributed design inherently handles large volumes. Competitors might hit capacity limits on their dedicated scrubbing infrastructure.
And it sounds like certain sectors, like finance, are noticing this difference.
Yes, the transcript suggests that industries facing massive attacks are realizing the limitations of older models and are moving to Cloudflare specifically for that architectural strength and resilience.
Interesting. They also touched on the AI-driven internet shift. More bots crawling, maybe fewer humans visiting media sites. Does that impact Cloudflare?
It's a trend they're watching, for sure, but Cloudflare is more about the efficient, secure delivery of all data bits, not just web pages for human eyes. AI models need robust infrastructure, too.
So they're focused on the pipes, less on what specific content flows through them.
Kind of. They care about valuable bits, not just, say, raw video streaming, which might be lower margin. The infrastructure for AI is definitely valuable.
Okay, let's talk money. Cash flow. Operating cash flow looks pretty strong in Q1. $145.8 million. That's a big jump from last year's $73.6 million.
Yeah, a significant improvement. It's driven by a few things. Their net loss improved when you adjust for non-cash items like depreciation and stock comp.
And changes in working capital help too, like deferred revenue.
Exactly. Increases in deferred revenue, basically customer payments received upfront, and managing accounts receivable positively impacted cash from operations.
They also have that $400 million revolving credit facility unused as of March 31st. That seems like a good safety net.
Definitely. It gives them financial flexibility, liquidity without needing to draw on it immediately, shows good financial health and planning.
And something about a cash settlement for capped calls, resulting in a derivative asset. Can you break that down simply?
Sure. So companies issue convertible debt sometimes. To avoid giving away too many shares if the stock price goes way up when that debt converts, they buy these things called capped calls. It's like insurance against dilution up to a certain stock price.
Okay.
With their 2025 notes maturing, they opted to settle the related capped calls in cash. Because the stock price was favorable relative to the conversion terms, they were essentially in the money on that hedge, creating that derivative asset on the balance sheet, basically, value they expected to receive in cash soon after.
Got it. One expense that did jump was stock-based compensation, up to $95.5 million from about $70 million last year. Why so much, and how should we view that?
Well, stock comp is super common in tech. It's how they attract and keep talent, aligning employees with the company's stock performance.
So it's an investment in people, essentially.
Largely, yes. It hits the income statement, but it's a non-cash charge, so it doesn't drain operating cash directly like salaries do. Investors usually see it as part of the cost of growth in tech, as long as it's managed well.
Right. Okay. No analysis is complete without the risks. Cloudflare flags the usual forward-looking statement caveats. What are the big ones sticking out in their filings?
Well, the fundamentals. Attracting and keeping customers, especially those large ones, that's critical, and getting existing customers to buy more services.
And making sure the products actually work.
Yeah.
Right, especially security.
Absolutely. A major breach would be damaging. Then there are legal risks, what customers do on their network. Privacy laws like GDPR, CCPA. That's a complex web.
What about managing growth itself?
That's huge. Scaling support, keeping the network reliable, handling competition, maintaining the culture. It's a constant challenge. Selling to governments also adds complexity, compliance, costs, competition.
Any other significant risks mentioned?
Yeah, integrating future acquisitions is always tricky. Network disruptions or security incidents are ever-present threats, tax complexities globally, IP infringement claims, stock price volatility, and potential lawsuits. It's a pretty standard list for a company like this, but important to keep in mind.
Okay, last section. Equity structure. They have that dual-class stock system. What's the main takeaway for investors there?
It means voting control is concentrated with insiders, mostly pre-IPO holders. So your vote as a regular Class A shareholder has less weight on major decisions.
And things like anti-takeover provisions need a supermajority vote to change.
Right. It provides stability for management's long-term vision, perhaps, but reduces shareholder influence compared to a single-class structure. Stockholders also can't act by written consent, only at meetings.
Their stock trades as net on the NYSE. Any dividends? And what about dilution?
No plans for dividends currently, so returns depend on stock appreciation. There are still convertible notes due in 2026 outstanding, which could dilute shareholders if converted into stock.
But they have those capped calls for the 2026 notes too, to offset some of that.
Yes, similar to the 2025 ones we discussed. They're designed to reduce the potential dilution or cash payout if the stock price is above the conversion price when those notes mature or convert, but only up to a capped price around $250 per share for the 2026 notes, I believe.
Okay, so summing up Q1 2025 for Cloudflare. Strong revenue, really good momentum with large customers. Platform seems to be resonating, especially workers and zero trust.
Definitely positive signs on growth and platform adoption. The network architecture continues to be a key differentiator, and operating cash flow showed a nice improvement.
But as always, you have to weigh that against the risk we talked about: competition, execution, macroeconomic factors, the complexities of their global operations.
Absolutely, it's a dynamic space.
Thanks for joining us for this deep dive. We hope this analysis of Cloudflare's Q1 2025 performance has given you a clear understanding of what they do, all they grow, all why it matters. So here's something to think about. Cloudflare had a strong start to the year. They're investing heavily in growth. What key metrics or signals will you be watching in their next reports to see if they can keep this momentum going, especially with all the shifts happening in AI, security, and the broader economy? Until next time.